Welcome back everyone to the Joseph Carlson Show. In this video, we're going to talk about why Amazon is essentially a worthless company. That's right, you heard me right. We're going to look at a bear case, a short thesis on Amazon, where this Twitter user, Hank CFA, so he's a CFA, he says that Amazon is a good short. It's a company that's going to go down in value a lot, and his thesis hinges on these two key thoughts here. Now let's go into just the two key thoughts. Despite its incredible growth, he doesn't think that AWS, Amazon Web Services, will be an amazing business that everyone else thinks it will become. And then number two, he doesn't think that the online sales is worth anything at all. So that's basically like two halves of Amazon. The AWS business, he doesn't think is going to be an amazing business. That's his words. And he says that the retail business is essentially worthless. So anytime someone comes up with a bear case and they're saying that AWS is not going to be an amazing business or that Amazon's retail is worthless, well, this catches my attention. I look at this and I think, I have a lot of money invested in this company. So when I see someone on Twitter openly putting this bear case up, I want to take a look. I want to observe it and see if they have any good points. Maybe I'm missing something. So I thought that I'd take a look at this, and instead of do it alone, I wanted to take you with me. So I'll just give my initial reaction to this and we'll go through it together. Now, again, having said this, I am an owner of Amazon stocks. So I have a lot invested into it. So you're coming from that perspective. If you like this type of content, also make sure to subscribe to the channel. We have a lot more of it coming out soon. Now, let's go ahead and dive into his actual arguments here. Again, he says, despite its incredible growth, I don't think that AWS will be an amazing business. Everyone else does. And two, I don't think the online sales is worth anything at all. Now, personally, I've seen the second one a lot. I've seen many people say that Amazon's online retail sales is worth nothing because it doesn't generate much of a profit. That's number two. It's false. It is worth a lot. It's not worth nothing at all, certainly, but I'll get to that later. The first thing he says is a little bit more shocking. He says, I don't think AWS will be an amazing business that everyone else does. Right off the bat here, I know I'm talking to a CFA, so sorry to be presumptuous here, but just entertain me here for a minute. Right off the bat, I think this is a ridiculous statement. You don't think that AWS will be an amazing business? What do you mean will be? AWS is already an amazing business. They do $19 to $20 billion of revenue per quarter, growing above 30% per year with EBIT margins of 30%. And contractual obligations of customers in the range of 100 billion plus. What would you define as an amazing business if AWS is not already one? I'd like to hear the definition, Hank CFA here, of what an amazing business is. Because I think a business that has $100 billion of customer commitments, is growing 30% per year, and has EBIT margins of 30%, I think that's a pretty amazing business already. So right off the bat, I disagree with this. But again, let's go in. Let's hear his full argument here because he lays it out in these tweets. Starting with AWS, cloud computing may credibly have one of the largest tech TAMs. TAMs is total addressable market. It's a fancy financial term for how big the company can grow into. So cloud computing obviously has a big addressable market. He says, and the speed of adoption has been staggering. That's true as well. However, 3 of the largest companies in the world are competing for share. And that only leads to one thing, margin compression. All right, so he's making the case that like capitalism, the laws of capitalism, when any company builds something really cool and it has high margins, lots of other companies want to get in on those margins, lots of competition, and it lowers the margins overall. He says that AWS had 13.6 returns on invested capital in 2021 and EBIT margins of 30%. Impressive for sure, as their 33% revenue compound annual growth rate from 2019 to 2021. But there's almost no differentiation between Amazon, Google, or Microsoft products. So why will these margins remain? Now he goes on breaking down the math of this, and he has this very convoluted way of saying that AWS is really only worth $210 billion. I fully expect normalized EBIT margins to be somewhere between 5 to 15%. So he thinks the margins are going to go down from 30% to 5%. That's the range of margin compression. And he's saying with the margins going down from 30% to 5%, AWS is really only worth $210 billion. He says other analysts ascribe AWS a standalone value of 600 billion plus, which I think is low. I think AWS alone is worth over $1 trillion. Again, it does $100 billion of revenue with 30% margins. It has 30% growth rate, and it has over $100 billion of contractual obligations from customers, which again, that contractual obligation is growing every single quarter. Everything about the company is incredible. But he says, analysts say it's above 600 billion. His valuation on it is 200 billion. He thinks the margins are going to go to 5% from 30%. And he says, even at a 15% margin and a 15 times multiple, both I view as generous for a commodity business. So he calls AWS a commodity business. There remains an enormous valuation gap. Then he goes on to part 2, the online stores. Now, before moving on and addressing the false claim that Amazon's retail business is worthless, I want to address this first claim that AWS is not going to be a great business. The assumption here is already incorrect. Amazon's AWS is already an amazing business. So you're making the assumption, Hank, or however you say your name, you're making the assumption that it's going to go from a great business to a very poor business, where the margins go down from 30% EBIT margins to 5%. So the margins contract by 80%. And your reasoning for that is that Google and Microsoft are copying Amazon. That's the big argument here. Google's copying Amazon, Microsoft's copying Amazon, therefore they're commoditizing the Amazon AWS product, and when things get commoditized, margins go down. Have we really seen that with a lot of companies? Anytime someone copies them, the margins go down? Look at Starbucks as an example. That is a commodity product. It is coffee. Look at the margins of Starbucks compared to competitors. There's something that protects their margins. There's something beyond that. Look at any business, Nike. Commodity product. It costs $5 to make a pair of sneakers. It's not really expensive. The Air Jordans that you can make, they cost probably $10 to make. Really not a lot of cost behind it, but they sell them for $120. Shoes are a commodity product, but Nike routinely sells them for a very expensive price. Now, what is it for these companies that keep that high price and those high margins? Well, even though they're being copied, they have brand value. That's something that protects their moat. And they have large distribution networks and agreements that also keep their moat. So they have structural advantages and they have brand value. Now, Amazon has something similar to that, but not the exact same. AWS doesn't really have brand value per se in the same way that Starbucks and Nike do, but they have something different that I think is equally as powerful of a moat, which is customer lock-in. It is incredible how much lock-in a company like AWS has, or for that matter, Microsoft or Google. When customers sign up for one of these companies, they don't change companies. They simply do not change companies. Trying to go back and refactor old code that has specific lines of code, thousands of lines that are specific to AWS, takes a lot of development effort. So rather than going through development hell trying to refactor a bunch of legacy code, companies will continue to keep on the same clouding provider they initially signed up with. That is lock-in. And all of these companies have it. Cloud providers have immense lock-in. You can use the example of another company that had lock-in, Oracle. Why does Oracle continue to keep so many legacy customers that are such high margin customers? Lock-in. It's difficult to move out of Oracle. The same thing with IBM. Even though these companies are super old and they've been around for a long time and they're these boomer companies, they make so much money with their legacy corporate products because of customer lock-in. AWS has immense amount of lock-in, and even if they are commoditized between Microsoft and Google, once someone signs up for one of these companies, they're not switching. Another thing that I'd look at as an example of this, we can look at the actual data here. This is AWS's customer commitments in blue compared to their revenue in red. And this is mapped out on a quarterly basis, not an annualized basis. So every single one of these is one quarter to the next. It looks like it's growing fast enough to be annual, but I promise this is quarterly. Back in 2018, the commitments for AWS, which is contractual agreements for customers to use AWS, they're locked into it literally by contract, was $12.4 billion. Now that's gone to $100 billion. So there's $100 billion of money waiting to be spent on AWS that's already locked in, already agreed upon. And that number's doubling every 2 years, from $52 billion in 2021 to $100 billion in 2022. So doubling in 1 year from 50 billion to 100 billion of customer commitments. At the same time, it looks like this AWS is not growing fast, but that's only because of how fast the commitments are growing. Amazon's AWS revenue in 2018 in 1 quarter was $5.4 billion. Now in 1 quarter, it's $19.7 billion. The revenue of AWS alone is in line with Tesla. They're both revenuing around the same. Not of Amazon, just AWS. And it's growing incredibly fast as well with high margins. And again, all of this lock-in from customers. So I think this is problem number 1 with this thesis. Saying that it's a commodity product, sure, between Amazon, Microsoft, and Google, it's a commodity product, but not between other companies. If you start a startup company, you're choosing one of these 3. You're not choosing some random company to do your cloud hosting on. You're going to pick either Microsoft, Amazon, or Google. Once you pick one of these 3, you are locked in and you're not going to be switching. You'd have to have enormous financial incentive or huge feature set incentive to uproot and refactor thousands of lines of code that you've developed on AWS to move to Microsoft, or from Microsoft to AWS. Once you sign up for one of these, you are locked in for good. And that's the reason why so many customers are saying, you know what? I'm already locked in. I may as well get a discount and sign a multi-year contract. $100 billion and growing. So I think this is the problem with looking at this type of view of AWS as being this business that's going to have lowered margins. We haven't seen that at all. In fact, this assumption that the EBIT margins are going to go from 30% to 5% because of increased competition, if that was the case, why has that not happened already? Look at the actual data here. Microsoft Azure isn't new. It started in 2010. Microsoft has been running Azure for over a decade, competing fiercely with Amazon. And guess what's happened to AWS's margins over the past decade? They've increased, they've widened, they haven't contracted, they haven't compressed. The margins have gotten better over time as Amazon's become more efficient with their hardware. Likewise, Google isn't new into the cloud game. They've entered into that over a decade ago. And even in recent years, they've competed more harshly with Amazon, more ferociously with Amazon, and the margins have gone up. If margins were going to compress in light of increased competition, why hasn't that already happened? Why hasn't that taken place? Increased competition has already happened. The reason why is because customers are not going to leave from one to the other. These companies are not going to price themselves down to making no money in pursuit of market share when they already demand the market. So far, to summarize this argument that AWS is not going to be a great business in the future, it's not based off of any type of data whatsoever. All of it is theoretical. None of it is based in reality. So far, the reality is AWS is an incredibly good business with high margins that are increasing over time in the face of increased competition, and they have increasing customer lock-in with more and more customer commitments that are multi-year contracts. What we don't see is increased competition from Google and Microsoft lowering the margins of AWS, and we don't see that happening with Microsoft or Google either. We also don't see this being treated as a commodity product where consumers pick any cloud hosting provider one day and they switch over to another one. They simply can't do that. It's not like where you can order one pizza one day from one pizza shop and another one another day from another one. Once you pick one of these companies to go with, you're pretty well locked in. It's very difficult to move. You'd have to have immense financial incentive or some product, some feature to move away. So I don't see either of this argument. I think it's highly theoretical. I don't think any of this is based in any type of evidence whatsoever. I'd have to see the margins actually come down to believe this at all. Now, let's go ahead and move on to part number 2, the online stores. Hank here has said that the online stores are essentially worthless. He says, how does a business that loses money, has never made money, and at best becomes break even worth anything? The answer is it isn't. Now, already I like this argument more, because at least it's based in current reality. He's saying that the retail business hasn't posted a profit with Amazon, so it's essentially worthless. That at least is based on some level of current data. Unlike his AWS thing, that's all theoretical. None of it's based on current data. None of that makes sense in any type of context unless you're just theorizing about the future. This at least is based on current data. But to answer this question, how is a business worth money when that business in and of itself doesn't generate a profit? Well, I don't know if you're aware of this, but some businesses are simply there as loss leaders or a way to provide growth in other business ventures. For example, the Costco hot dog being sold for $1.50, and it comes with a drink, right? The Costco hot dog combo, that's a loss leader. Customers come in to buy that $1.50 hot dog, but then while they're there, they say, you know what, I just want to walk through, check some things out, and then they end up walking away with an LG OLED TV that costs $2,000. That's a loss leader. So you think, how does this hot dog that loses money, how is it worth anything at all? Well, the answer is it isn't. Well, of course it's worth something. It brings people into the store. It converts customers to sales. It converts memberships to Costco. Costco understands this principle very well. You have a core business where you buy products and resell them to the customer neutral. Costco doesn't make any money from their retail business, so to speak. The exact same with Amazon. The retail business doesn't generate any money. But since that retail business offers so much value for the consumer and runs at break-even price, it allows Costco to offer a membership where they make all of their money. So now Costco has 60, 70 million members paying them every single year on a subscription basis. That's how a company, a business that doesn't generate any money, that's how it's worth something. It leads to other businesses that generate money. And Amazon understands this principle quite well. In fact, there's a lot of discussion, a lot of history about how basically Jeff Bezos copied Costco's business model and put it online. That's essentially what they did. You offer the core business for free and you attach on value propositions that are highly lucrative on top of that. But anyways, that's how you answer this question. How does a business that loses money, has never made money, and at best can be break even worth anything? The answer is it isn't. That's obviously false. This is a false statement. It's worth money because it brings money to other parts of the business. Moving on from this, he says, the platform historically provided a basis for growth, creating what amounted to $1 trillion of optionality. There we go. It brought in a lot of optionality. But it's hard to look backwards at the tremendous growth and say that it's going to continue. The Amazon brand is dated. The website is dated. I don't agree with that at all. I think Amazon's brand is fine. When I think of Amazon's brand, I think of really good value, extremely good customer service, breaking edge technology, all the ventures they're going into. I don't think of like a dated Kroger's brand. I think of a much more tech-oriented, future-looking company. The website being dated, I don't agree with that either. I think the website's quite nice. I order stuff from it all the time. I don't know. Opinions vary. That's subjective. But I think the website's quite nice. And I think the other hundreds of millions of shoppers on it might agree. E-commerce sales have flatlined recently. We're already seeing this trend play out. E-commerce sales have flatlined recently. We're seeing the trend play out. And then he has this visual here. Let me bring this up. This is a chart showing estimated e-commerce as a percentage of total retail sales. And you can see it going down from 2020. Well, Hank, what happened in 2020? Obviously, it was an anomaly where the trend went far above trend because of COVID and the lockdowns. So of course, e-commerce went up a lot when people were locked in their homes and they couldn't go to physical retail. You see it come down over the past year or so, but this doesn't support what you're saying at all. This shows that retail sales are just on trend. We see this right here. It went from 2020, it went up a lot, and then it came back down, but this little dotted line is the trend line. So far, there is no evidence whatsoever that retail sales have slowed down below trend. We had a one-time anomaly in 2020, which is totally reasonable. Maybe the retail sales will slow down if this stays flat over the next couple of years. But so far, nothing in this image. In fact, this entire image doesn't support the claim you're making at all. The retail sales are perfectly on trend. If they flatline from here, they won't be. But you see the dotted line, they're not below it. They're right on trend. So again, he offers some data here that doesn't support the claim that he's actually making. Continuing on with this, there is no reason to believe that they'll run the business in a cash-burning manner. I think there's reason to believe they'll do that. It's to provide optionality to other businesses. He says, but I don't think it's going to ever produce the tremendous optionality that it once did. Again, theoretical assumptions about the future. So far, the retail business has produced a ton of optionality for Amazon, but that isn't to say the rest of the business isn't incredible. Okay, so we're going back on this. Now he's actually saying the rest of Amazon is incredible. The third-party seller services has probably eclipsed UPS for volume. I think it has. I think it's going to devour both UPS and FedEx. I would put its standalone value between $150 and $200 billion. I think that's pretty low. The ads business is incredible. Although captive to Amazon sales and Prime, I'd agree with the street and put its value at $125 to $185 billion. So now he's attaching valuations to these. He says the Prime membership is now a Netflix subscription. It's way more than a Netflix subscription. On the list of things that people cancel, Prime membership is one of the last. But he says, but with a higher value add to customers, I put the business somewhere between $100 and $160 billion. Whole Foods has continued to expand and likely has grown to a $17 billion valuation on Amazon's acquisition. Then he has this chart here showing his estimates for Amazon's value. He says on the low end, it's worth, and this is the entirety of the company, all of it combined is worth $556 billion. On the high end, it's worth $873 billion. So there's 53% downside to 26% downside. Amazon is way overvalued even after this recent market drop. Now, when I look over this breakdown of the low estimates and the high estimates, a couple things stand out to me. Obviously, AWS being worth $160 billion on the low end. Again, it does $100 billion in revenue per year with 30% margins. I'd like to see any comparable company that does $100 billion per year in revenue, has 30% margins, and is growing 30% per year be valued at $160 billion. I'd love to see that company. You're not going to find one, but I'd be interested to see it. The other thing that stands out to me from this bear thesis is the online stores being worth $0. Not anything, not even one-time sales. They're worth $0. Now, keep in mind, the online stores, the first-party stores for Amazon, does $200 billion of revenue per year. So he's basically saying a part of Amazon that does $200 billion in revenue is not worth anything at all. Zero value, zero anything. That part of the business is completely worthless. Amazon should just spin it off and sell it for free. And if they can get 1 penny out of it, they've made a good sale. They've gained value there. Obviously, I don't think that's true. Online sales is worth something. They do $200 billion in revenue. And I'm sure if they wanted to, they could squeeze out some profits if they weren't driven to grow profits in other places like ads, Prime, and third-party seller margins. So Amazon is choosing to use the online sales as an avenue of growing these other businesses. That does not mean that this is worth zilch. That's like saying the core business of Costco is worth nothing. Zero value from it because Costco chooses to monetize it in a different way through memberships. Obviously, the core business is still worth something because it's the driver of these other products. The same exact thing with Amazon. The company takes a very long-term perspective where they're willing to sacrifice profits in one part of the business to grow other highly lucrative parts of the business. So this is the type of analysis we're getting now. In my opinion, things have moved from being overly bullish to now overly bearish. We're seeing sentiment change so much to the downside that people are saying Amazon's only worth $500 billion with AWS included. Very pessimistic in my opinion. I think that the truth between these overly bullish takes in 2021 and now these overly pessimistic takes, I think the truth lies somewhere in the middle. I think companies are probably worth somewhere in the middle between the two. But right now, I'm seeing sentiment go so far south. There's a lot of investors that right now think the market's just going to continue to go down indefinitely, and all of these great companies are worth essentially nothing. So we'll see what happens in the future. Hope you enjoyed. See you next time.